Hello, John Burley here. Great to be talking again. Hey, I want to talk about the three niches of real estate investing today. A lot of people get a lot of things confused. They confuse sources with niches. Niches are what we decide to do, and it's really, really important, especially if you're new. I get a lot of new investors, and they go, John, I found a house. What do I do? And it's like, okay, well, what do you think about doing it? Well, I may do that flip thing or that assignment, that quick cash stuff, or I may just hold it as a rental, or maybe I'll do some owner financing. I don't really know. Okay, they're already in deep trouble. There's three different niches out there. The first niche is, just the classic quick cash. And today that might be an assignment, that might be a novation, that might be, a classic renovation rehab. It might be we're going to sell it to a wholesaler, we're going to buy from a wholesaler. But the whole idea with it is that we're going to take the asset, we're going to control it or own it for a short period of time, and then market to somebody else. And that is quick cash. A lot of pros and cons to it. The first big one, obviously, is you get cash right away. The downside to it is you have tremendous market risk pressure, which we're experiencing right now for a lot of people who didn't pay attention to history, and history is repeating itself because people don't pay attention to history, and obviously a lot of short-term players have gotten caught in the last 9 months to a year. So always market risk is the main thing that we need to be aware of. And then money supply. Do we have money to do deals? And then the third thing is deal flow. Are there enough deals to make this a viable way to make a living? And, with the quick cash, I love quick cash. I love the flips. I don't do a lot of them anymore and haven't for decades. And the reason is they don't get me what I want, which is financial freedom. We do teach it. We do cover it. I have done a bunch of it. And so number one, then quick cash. Number two, the second one we look at is we look at just a traditional buy and hold. And look, outside of the hype and glamour of, real estate education and real estate seminars, what I kind of refer to as seminar land affectionately. The idea with seminar land is that when you're at the event, and trust me, I've learned so much from so many events. I literally have spent over $1 million going to events over the decades. But in seminar land, at so many of the events, they're not based in the real world, meaning that it's like, hey, if you get my course, you get my package, somehow magically you're going to get rich doing nothing, sitting at home in your underwear. It's like, and that's not how life works. That's not how the world works. That's not how it's ever going to work. All it is quick cash. Is in the real world, it's a new job. It's a way to make more money than you used to make. And like I was taught in the old days, was kind of traditionally, it's like, well, you start flipping, and then after you do some flipping, then you do some rentals, and then, maybe you get into some of the more sophisticated stuff. And I was just kind of like, okay, well, that's, stupid. If I don't want just short-term money, if I want long-term money, then I should do long-term right away. So the number two is the buy and hold. Buy and hold's great. It's boring. It's classic. It's been around forever. And quite frankly, outside of some exceptional students, and we got just so many Century Club members who did the third model that I'll talk about in a minute. Most of the normal people that I meet at a club around the world, people I haven't taught myself, most regular people that I met, they got rich just doing buy and holds. And it was the classic. You save up your money, you find a good deal, you buy a house, you put a down payment, you hold on to it. Over the years, you pay it down. It was always a big part of the model was you're going to pay it down. You weren't going to refinance every 30 seconds or every 3 months or whatever they explain, which works great until interest rates go up. Then you can't do that ever again. You're dead in the water. You just bought them, you hold them, and then, at 10, 20, 30 years down the road, you have a bunch of houses. I have one of our students, good friend, Ralph Harding, lives down in Tucson area and up in Pine Top Lakeside where we have our summer home. He literally only has 42 houses, which is a lot, but from our perspective, that's not a lot because we really look to Century Club members. But 32 of the houses are free and clear, and the 10 are close to free and clear. So he makes $55,000 a month net positive cash flow. And every month he's paying the other 10 down because they own their 2 homes, they own their cars, they own their furniture, they own their toys, they have everything they want. So it's not like they need a $1 billion to live on. So most of their cash flow, they just use to pay the loans down. So he'll soon be at $60,000, $70,000 a month for the rest of his life on free and clear properties. So buy and hold's great. You need to really know your numbers, and we need to not be naive. So a lot of people are like, oh, well, the house rents for $1,800 a month and my payment's $1,400 a month, I'm going to make $400 a month. You're not. Kind of the rule of thumb in buy and hold, and I'll go over these more in detail on another broadcast. But the first rule of thumb is that you're 8 to 10% property management, and if you do it yourself, you should put those numbers in because you shouldn't work for free. Who'd want that job? And then the other thing is that it's about 25% on a solid Class B, less than 30 years old. So we're not talking Class C, which goes way, way up. We're just talking a solid Class B property. About 25% of your gross income goes to expenses over the long term. So really, property management is not 10%. It's 10% plus 25. It's 35. So you've got to buy well, or you got to have a low interest rate. So buy and hold works. It's great for the long term, and you take out the market risk, because whether the market's up or down, it doesn't matter. If the market's down, we don't sell. If you wanted to sell, you'd only sell when it's up. So, and the main thing is just to make sure that your income stream comes in every month, covers that reality, principal, interest, taxes, and insurance, HOA if you've got it, and you've got to cover the 25 and 10 expenses, which makes it tighter if the markets are tighter. So that's buy and hold. The third one is the one that we do the most as part of the Burley model, is we do owner financing. So we acquire the property. Ideally, we buy it for below value, which is becoming very easy to do again. We make sure it's positive cash flow, but we take some things out. So since we provide home ownership, which is the American dream, which once Dodd-Frank passed became even less of a reality for most Americans. Dodd-Frank was done in 2014. Not one administration has done everything bad in our lifetimes. All administrations have good things and bad things if one is objective, which I try very hard to be. And so what we know is that about 35, almost 40% of people who do not currently own a home cannot buy a home because of rules and regs like Dodd-Frank. And, the government gives lip service to everybody should own a home, everybody should own a home, and then passes laws and rules and regulations that make it harder. And the banks give lip service, oh, we're the friendly bank, we want to help you own a home, we want to help you own a home, and we don't. The FICO score is extraordinarily discriminatory against the middle class, the self-employed, and of course the lower middle class in regards to ownership. Because part of it, to get a high FICO score, you have to have large amounts of debt or large amounts of debt available for you to borrow, like lines on credit cards, HELOCs, et cetera, that you do not use. So for most regular people, although FICO scores go to 899, and I have seen an 899 in one of my capital investors, and lots of people in the 830s, 840s, 850s, 860s, 880s, they have massive amounts of borrowing available to them that they're not deploying. For a regular person, they got the car loan, maybe a house loan, and then they've got credit cards that might total of $5 or $10 grand. So they're looking at max of a 695 to a 715, 725, which means a couple little teeny boo-boos that have nothing to do with buying a house, and they're out of the water. So what we do is we come in and we do common sense underwriting. We still run a credit report. We do all the due diligence. We actually have underwriting requirements that are superior to what Dodd-Frank put in 2014. The mortgage industry is still whining and complaining about. Since 91, we've had superior underwriting requirements than that. Like making sure they don't do an FHA 48% debt to income ratio, which is a predatory loan, federal government. We only do 3 to 1. So that they can pay for it when the bumps happen in life, which happen to everybody. And so with the owner financing, the idea is they will pay a premium. Think like a used car, a secondhand car with the financing done by the dealership. Not the buy here, sell here, Sam's used cars at 18 or 24%, but a fair market rate, which, they would be 8-9%, somewhere in that range. So we provide the owner financing, which means we get a premium above fair market rent. People will pay more to own rather than be stuck renting. They get a chance to build up all the things that go with home ownership, and mainly just the stability for the family. Because literally 65% of our new residents coming in the last 5 years, they didn't do anything wrong. They didn't want to move. The landlord sold the house out from under them, and so they had to move. So one of the big things we do is our shortest term we do on owner financing is 10 years, up to 30. On the 10-year model, that means that mom and that dad and those children can stay in that home for at least a decade. For a lot of the mothers, that literally is just like, great, where's the paperwork? We're in, sir. Because they're so grateful they won't have to move again and relocate the family and change schools and all the stuff that goes with that. And then with the owner financing, since they're the owner, that 10% and 25% on paper, 100% of it in reality, 85, 90% of that all goes away. So we reduce the expenses dramatically, and we increase the income dramatically, so that spread, the difference between what our normal debt service would be and our expenses, that goes down while the income goes up, so we make a much bigger spread. And in today's market, even with interest rates having ticked up, it's still very common for us with a new loan to get $600, $800, $1,000 a month. And those are properties that are running in the $250,000 to $350,000, maybe $400,000 on the top side range. So the numbers are quite viable today. So number one, we do the quick cash techniques, which is all the things around flipping, and we really nail it down, and we'll talk about that in the next video. Then we go through and we do the buy and hold, and we're going to go through buy and hold and what we do on the buy and hold side in a future video. And then the cash flow side and the unique things. So they're all unique. They all serve their position. Cash flow designed to maximize income streams today and get you moving forward toward that number to where you can leave that full-time job and begin to live a new job as an investor and or retire better and faster than planned on. The buy and hold is a slower process that builds up, and the quick cash was designed just that, to give you quick cash, but quick cash was never, ever designed to make you free. And I think that's where a lot of my brother and sister real estate investors kind of got off track. See, I knew when I became a real estate investor, it wasn't to make more money. It certainly wasn't to get a new job. It was to be free, to be financially free. Freedom to me meant that every single month I would get checks that came in, and back then it literally was mailbox money. Then, of course, it became ACH transactions and now other electronic devices. Most people still just every single month pay it in some electronic form. The money goes into my account. I automatically make more money every month. I automatically have more income every month, and our cash flow well exceeds our lifestyle. So we have lots and lots of excess funds. And that gives choices. See, the freedom is from the money, gives you freedom of time, and freedom gives you choices. So most of you, you're just like I am. What you wanted was to have the choice to retire better and earlier. And then if you love what you do, you'll probably keep working. I don't work the hours I did when I was younger, but I still work a good amount of hours running my private equity company since 1989. Hey, so 3 niches, quick cash, buy and hold, cash flow. Really important you choose before you go, because you need to know what that target is. Otherwise, how can you hit it? Hey, if you like what we're doing here, follow us on Instagram at john.burley. Make sure and join the John Burley Real Estate Investing group on Facebook. So John Burley Real Estate Investing, it's a Facebook group. Make sure and enjoy that. Also, here on YouTube, look, like, comment, subscribe. Let us know what you want. And really important, if there's subjects you want me to cover, let me know and I'll do it. As my wife would remind me, I don't know how to read minds, so I need to be told. Also, make sure and check out johnburley.com, JOHNBURLEY.com. We've got a lot of really great free downloads for you there. And also, you can find out information about our upcoming events. This is John Burley. Hope you enjoyed today. Thank you, and God bless. Take care.